really an absolute pleasure having you. I think we crossed paths on X
Yep.
not long ago, and as we just launched our podcast, we wanted to actually always get a take on both sides of the story of entrepreneurs. The hustle on Friday, founder roller coaster journeys, and then on the other side, obviously, it's always the worry and stress of raising money. How does one go about it? Who does one speak to? And all sorts of, I guess it's a labyrinth. So I thought it would be interesting to get this podcast going so that we've got a real picture of both sides, as well as also just putting a human side to it. An investor is not just a bank vault. It's also a person who's
Yes.
who's who has a story to tell. So I guess that's why we're here. So to start off with, we're going to be breaking the ice. I don't know if you're drinking something in particular, but it's early in the morning. Tea, coffee,
I
pipe
am a
juice.
I am a coffee guy I don't have my Incisive Ventures Yeti coffee cup. I'm addicted to these Yeti coffee cups. Um,
Okay.
and but it's bulletproof coffee, so I have protein powder, butter, and some oil in there too. So it's a
Oh,
keto
wow.
coffee drink. It's good for ketosis and helps you fast in the morning. I intermittent fast until after lunch every day. So I'm a little
Okay.
bit of a
All
nerd
right.
about health stuff.
That's good to know. That's good to know. So basically, we're going to go back in time, a little bit of background, childhood dreams. If you had any that were interesting and that took you, actually, you lived your dreams, or you went on a completely different path on your journey, and what led you all the way to being a VC angel, early stage angel investor.
Wow, going all the way back. Well, the funny thing, you might have seen on X, my older daughter just got accepted to Georgetown Medical School. And I was really
Yes.
proud of her, but mostly because when she was 6 years old, when other girls were playing Barbie, she was playing doctor. And she said at 6 years old, I want to be a doctor. And we encouraged that all
Okay.
the way. And now she's going to medical school. She's someone that has had a singular purpose the whole time. And it's
Okay.
really exciting to see that. I'm not sure I would say I had a single purpose in time, but at 6 years old, I wanted something. There was this little transistor radio that at the time it looked like a satellite. It was round and on a keychain and like an AM FM radio. And I asked my parents said, we don't have any money for that. You have to get your own money. And I'm like, well, how do I get money? And they said, well, you have to, do a job or start something. And I said, well, how about I do a Kool-Aid stand? And our house was actually in between a parking lot and the University of Florida football stadium. And I noticed that on Sundays, lots of people walked from the parking lot to the stadium. And I thought, well, maybe
Nice.
I set up a Kool-Aid stand in front of there and I might be able to make some money. The radio was $17. I made like $45. And that was my first entrepreneurial thing where I wanted something. I did it, an entrepreneurial thing. I made money. I was able to get what I wanted. That got me, I was hooked. I was hooked on this entrepreneur idea. Right.
Okay.
And so I started doing all sorts of things, mowing lawns, delivering papers, which isn't a job anymore. But I always liked the idea of, if you want something, create value for other people and you'll get it. And so that stayed with me the whole time. And in college, while everyone else was studying computer science to do technical things like writing device drivers and solving technical problems with computers, I was interested in solving business problems with computers. So I was using spreadsheets to trade stocks and things like that. And so I got a double major in business and computer science because what always interested me was the business problems that were solved with computer science. And
Okay.
so that's why out of college I went to Anderson Consulting, and then I went to Microsoft. And after Microsoft, I started my own company called Loud Eye Technologies, which was a streaming media service provider. And we ended up taking that company public after 3 years for a $2 billion market cap. Absolutely the last company to go public in the dot-com boom. And I mean, it was a great time when you could get a $2 billion market cap for a company with $10 million of revenue. But while I was at Microsoft, I also was working with other entrepreneurs and got interested in investing because I wanted to support these other entrepreneurs that were doing exciting things that I wanted to do. And so I joined some venture funds. I started some investing. So I've always been on both sides of the equation, an entrepreneur and an investor. I was 3 times a entrepreneur, 2 IPOs. I raised over $500 million. I'm an LP in 17 funds, and I've invested in 250 companies directly. And now I'm basically a full-time venture capitalist because at this point in my life, I prefer the work-life balance of being an investor versus an entrepreneur. But I've had lots of entrepreneurial experience, and that's why I think a lot of founders enjoy working with me because I've been in their seat.
Yeah, and you're very, very approachable, I must say. I mean, I've been reaching out to quite a few people, and I really, really appreciate you having accepted to come on.
Well,
Next on my Go
the
for it.
problem
Sorry.
that you talked about, and I'm glad that you're doing this podcast, is exactly one of the problems I'm trying to help solve in venture capital, is that entrepreneurs and VCs are in this low probability matching game, right?
Yeah,
Entrepreneurs hear no
100%.
99% of the time. VCs say no 99% of the time. What can solve a low probability matching game? Well, if you both communicate a little bit more and say, this is what I like, this is my sweet spot, this is what I'm interested in. Maybe people who of like interest and can find themselves and get that magical, partnership going. That's why I started being a little more
100%.
active on Twitter, not to try to be right and tell people how venture capital is, but to say, if you're pitching me, if you want money from me, here's what I'm interested in. And I think the more VCs that did that and the more entrepreneurs that did that, you can solve this low probability matching game.
Yeah, 100%. So, I mean, that's something also, and the fact that you're actually really quick to respond. So, I think I sent you 3 pitch decks because these entrepreneurs are early stage, and you just said, not for me, keep it coming. And I was just like, all right, now we've got something. And then obviously, then I started digging, and this podcast is obviously also going to help me, see if I ever get, because I've got startups coming to me every day saying, we need help, we need to set up, and we need to raise. So in a way, my commissions, what I do is my commissions, I don't cash out on them. I actually take them as shares. So it's one way of
Mm-hmm.
doing it. I think it's a bit unique, but that's how I found my little niche, and really want to actually match people and conversations and interests in terms of when it comes to investing or finding raising funds with the right investor. So I guess we'll come down a little bit later as we go into the deep dive. Leisure. Any hobbies or leisure activities that allow you to find yourself or recalibrate, including motorbikes?
I do a little bit of motorbikes. I have 5 Harleys. But the
Okay.
most popular one that I do is probably mountain biking and surfing. And
Okay.
I just did about a 20-mile mountain bike ride on Sunday. And I use an old school bike, not an electric one. I think it's cheating to use an electric bike. Um, but surfing really teaches you patience because you're sitting there waiting for a wave and you got to be in the right spot. And I think both of those for me just give me something to do, which takes my mind off of my current stress and gives me a bit of a reset. I also ask founders like what their resilience practice is. The jobs we've chosen to take are high stress jobs, and if you don't have some way to reset or to manage the stress, it can get to be a problem. And for me, it's surfing and mountain biking.
Okay. Do you find that you do a lot of reading as well, or a lot less than? most people pretend, everyone's saying like, oh, read books, but I wonder where people actually find time to read 600-page books
Yeah.
and biographies and get work done.
I do read a surprising amount. I read about 50 books a year. And my hack for that has been the Kindle, because basically you can have, 500 books with you at any time. And I usually read when I travel. That's the most time on a plane or waiting at the airport. That's where I find the time. And I read a combination of business books and psychology books, a lot of stuff about Stoic philosophy, and some biographies.
Okay, great. And last one in the breaking the ice part is family life. What does it look like as an investor?
Well, one of the reasons I decided to focus on investing versus I think I'm getting a little sun thing there. That's weird. um, versus the entrepreneur is when you're CEO, and I've been CEO 3 times, that's more than a full-time job. That's like a 70, 80 hour a week job, at least the way I did it. And, I have 2 young kids, 13 and 8. Wanted a more of a work-life balance. I wanted to be at breakfast with them and dinner and have less travel. So that's why I decided to focus on investing. You have a little bit more flexibility with your schedule as an investor. I can take a week and go surfing, and the company employees are not going to worry about that. So for me, family is a pretty high priority, and that's one reason I decided to focus on investing versus the CEO. It's not that you can't have a good work-life balance as a CEO; it's just harder.
Yeah. Like, do you find that it's getting easier for CEOs today compared to when you were running things as a CEO because of, I guess, facilitated by technology or
Well,
the advent
definitely.
of a healthier lifestyle, I guess.
Well, definitely. I think, at least for me, the pandemic was a real wake up call to focus on your health. And I think most people realize that, all the comorbidities that caused death in COVID were things that were manageable, and that there was a pretty high ROI to put a focus on health ahead of when you might get sick. So I think there's been an increased focus on health, which I think is good overall. But the other thing, I think, I've been investing in early stage startups for 25 years. And as an investor, I think these next year or 2 years are going to be some of the best times ever. And part of it is that as a CEO, you can get more done with less money faster than ever before. It started with the PC, and then mobile, and then cloud allowed you to buy variable resources, and now you've got AI that allows you to program things faster. And you've got pretty easily outsourceable VAs and all things to Philippines and things like that. It's easier to plug in resources and get things done that you don't need to do necessarily yourself than ever before. I remember also the industry that we're working in, technology, is fundamentally a deflationary industry. You might have seen my tweet a little while ago. In 2008, I was buying lots of hard disk storage and video cameras for an audio video internet company that I was running. I was paying $100,000 a terabyte for disk space and
Wow.
$50,000 for a commercial quality video camera. I bought, a couple of weeks ago, the iPhone 15, which has a terabyte in it and a professional quality video camera and an internet connection and thousands of apps for $2,000.
Yeah.
This is fundamentally a deflationary industry whose capacity is going up every year. And that's one of the magical things about software that is not the same in any other industry. I can't think of any other industry that has been 99% deflationary in its core cost over the last 20 years.
Yeah, that's a good way and a good perspective to put it. I think not everyone thinks of it like that, but Thanks for that.
Yeah.
Deep dive, Martin. So daily routines. What's your daily routine?
Um, well, I get up not too early. I'm not one of these 5:30 in the morning guys. I'm more of a 7:30 guy, and I help my daughters get dressed and have them have breakfast, and then I make one of these protein bulletproof type coffees, and then I do some journaling and some meditation and a workout, and I usually don't pick up my phone for at least an hour or an hour and a half. And I do the hardest work that I have in the morning. Um, and then I do the more routine stuff in the afternoon. And I always have dinner with my family, and I usually catch up on reading and things like that after dinner. And I'm usually in bed by 10 or 10:30. So I'm not a late night guy that much.
Okay.
And I work out
Right.
pretty much every day
Every day?
around
Okay,
noon.
so
Work out
a
before lunch.
workout. Okay, so kind of what kind of workout are you having? A sort of a calisthenics type of workout, or are you really pushing some weights and things like that? Are you in the gym or more at home?
Well,
More.
I'm a little bit crazy about that. I have a $500,000 home gym, um,
Okay.
so I spent an insane amount of money. I used to run a company that has all these high tech workout stuff. So I have like a cold plunge and two infrared saunas and an ozone sauna and an
Wow.
infrared light bed, and so I have a whole bunch of recovery technologies. And then on the workout side, I mostly do like 3 days a week of aerobics or workout, which is usually on the Zwift, which is a bike on a Bluetooth trainer. And 3 days a week, I'll do strength training. And I usually do that with the Catalyst, which is a electromuscular stimulation suit, which in 20 minutes gives you the same as an hour and a half of weight training. I actually think strength training is more important than aerobics, and most of the science behind it is pretty solid. Um, I think strength training is more important than aerobic training.
Okay. All right. Criteria. Let's get into it. What niche or specialty have you invested in?
Well, one of the interesting things that I did when I just decided that I wanted to invest full time is I went through at that time, about 200 investments that I'd made. And I tried to figure out where I got lucky, where I had a thesis, what kind of thesis did I have that performed well that I thought I could replicate. And this is something not a lot of investors do. Many investors are any good deal investors. They see a deck, they like the CEO, they write the check, whatever the sector, right? And I had done that, and I had gotten lucky plenty of times. But as a professional investor, it's hard to replicate luck. And I am a big fan of trying to constrain your thesis to where you think you have an advantage. Because this investing thing, you're always in a low probability event. I mean, VCs are always taking the long odds side of a bet, right? The vast majority of companies we invest in don't work. So you've got them to have them work at a high rate, and you've got to invest in companies that you have some ability to help in some way to improve those odds. And what I found by doing the analysis was that when I had invested in B2B software companies that had a really, concentric network related to my operating companies, they're selling to Microsoft or Google or Amazon, places that I knew people, and had business models that I thought I understood, I could be very helpful to them. So I came up with this idea of B2B software companies that reduce friction at scale. When I was at Ignition Partners, we were the Series A lead of DocuSign. And DocuSign is exactly that, right? You've got software, you're signing a thing on your phone instead of printing out a PDF file and faxing it. So this is a business process that people do millions of times a day. You can do it better with software. And so I went looking for more like that. And so now that's what I invest in: pre-seed B2B software companies that reduce friction at scale. And it's been going pretty well. I mean, In the last 4 years, I made 74 investments. 6 of them were unicorns. Signal Rank, who tracks investor performance, tells me that's one of the 10 best track records of investors in the country.
It's awesome. That's a great track record, I guess. Um,
They tell
so,
me I just do my job.
so I guess that sort of um, partly answers what are you looking for, in terms of who you're going to invest in. But if we can go a little bit deeper, as in, what are you looking for in a pitch or a founder reaching out?
Well, it needs to be B2B software, and it needs to be pre-seed. I wrote a post about this on my blog called Venture Stages Defined, and I define pre-seed maybe slightly differently as some other people might define it. Some people think pre-seed is anything before the seed, like if you've got an idea and you're still building your MVP. I define the angel round as when you're building your MVP. So if you have, I just find pre-seed as starting after you have an MVP in the market for at least 3 months. If you have an idea and you're still building the MVP, in my mind, you should raise from friends and family, get angel money and stuff like that, and not raise from a professional
100%.
VC. Some professional
100%.
VCs will do that, but that's not what I define. So I define pre-seed as you've got an MVP in the market for at least 3 months. You've got to be B2B, and you've got to be in a sector that I care about. So that does not include crypto. It does not include hardware. It does not include drug discovery. It does not include B2C. And, it's funny. I mean, I put all this stuff on my bio and in my links and everything, and I still get crypto people pitching me. And I'm like, you're fucking wasting your time. I don't understand why you're doing that. Yeah, I mean, the other thing that I look for in a pitch, once I'm looking at the deck, is the key thing for me is who are the founders, and do you have more than one founder? I've found the solo founder thing to be incredibly hard. I have funded solo founders, but 2 or 3 founders are much better, in my opinion. And a second-time founder is better if you've built something. And then the real question that I look at is why now and why you? And a lot of people are missing a why now slide, but that's really the most important thing, because the idea you have, whatever you're building, I guarantee you there's 10 or 20 or 50 other people building it. And the question is why now and why you? And those are the most important things I look at in a deck. Why now and why you?
Okay, those are quite precise, and I think it's important every time we have a conversation with an investor, is actually really bringing that out and saying, okay, well, there's people out there looking, and if you fit all the criteria and you're building your pitch deck, this is what would be important to put in there. So thanks
Yeah,
for that.
yeah. There's lots of
Perfect.
good, frameworks for pitch decks, the YC framework and others. But if you look at the, DocSend statistics on slides that investors look at, it's like 3 slides. It's the
Yeah.
team, it's the problem, and it's the solution.
Okay. Perfect. Then successful ventures, reflecting on your experiences. Um, do you have anything that stands out, a story about a successful venture and why you think it was successful?
Well, one key thing that I look for, because the venture thing, you got to find outliers, and the question is, what's an outlier? Well, an outlier is somebody that has a counterintuitive thesis that turns out to be right. And so the most successful ones that I've invested in, are exactly that. So let's take, for example, Deal. I invested pre-seed in Deal, which is an employer of record, and to help people hire people internationally and now domestically. And the counterintuitive thesis was, and when they started, there were 2 or 3 800-pound gorillas in that category, like TriNet And a lot of people are like, oh, TriNet's got this problem solved. They've got 85% market share. There's no way anybody can do it. It's better. And what Deal said is, first of all, the NPS on TriNet is really low. People fucking hate it. It sucks. It's like old technology. And with these new technologies, we think we could build a better one faster. And we think that there's going to be a growing need for people to hire internationally and fully remote teams and this sort of work from home stuff. And we're going to really lean into that. And this is before the pandemic, right? And so the thesis was that people are going to want to hire more, diverse and geographically diverse teams. But the catalyst for really driving companies to do that had not arrived yet. So your bet was that catalyst would arrive. Now, we didn't know it was going to be the pandemic, but it was. And then it turned out to be right. So their thesis was counterintuitive in the beginning, that more people would want to hire remote workers and that they would switch to a new provider despite the leader having a majority share. And I had used TriNet. I hated it. I wanted an alternative for myself. And so I gave them, some money. There's lots of examples of that. Airbnb was that, right? People will rent their couches to strangers. That sounds crazy. Uber was that. People will, drive their friends around instead of calling a taxi. That sounds crazy. It was counterintuitive, and it turned out to be right.
100%. So, in terms of ticket sizes, when you started investing, when you were at Microsoft, I heard one of your podcasts. You were on a podcast and where you were talking about Microsoft and their licensing, and then you said, like, these guys are having a lot more fun than me. I want to invest. What
Yeah.
kind of what are we talking back then when you started, and then today, what's the minimum that you'll invest and the maximum, for example?
Well, back then, as an angel, my standard ticket size was $25,000. So you see a company you like, you just write them a $25,000 check, you kiss it goodbye, and you hope it comes back to you. And that's kind of a standard, angel thing. And now, one of the interesting things that I did, you might have seen the data report from Carta a couple weeks ago. In the pre-seed, the average ticket size is $25,000. So if a company is raising $1 million, the vast majority of the checks are $25,000. I am a pre-seed investor writing a $250,000 check. So what my strategy is trying to get in a similar time as the angels or early investors, but getting 10 times the conviction that they do and writing 10 times the check. And one of the reasons I decided to go for a larger check size is that, from before I started this fund last year, I had made about 66 investments. The average check size was $40,000. The return on that capital was 2.8x TVPI, 36% IRR, which is a good return. But I went back and I said, what if I had written a standard $250,000 check across the same companies? What would that return be? Well, that would have been an 8x TVPI and 112% IRR. So what that told me is that I have good deal flow and good selection criteria. I just need to write a larger check. It's hard as an angel to write, 10 $250,000 checks a year. As a venture fund, it's a little more practical to write that size check. And so that's why I'm doing it. You've probably heard of some of the $250,000 checks that ended up being very big. I mean, one of my friends was the first $250,000 check into Solana, and he returned $1 billion. So,
wow, amazing. That was a good check to write.
That was a good check to write. He basically doesn't have to write another check again in his entire life. So I write $250,000 checks, and I do more diligence. I do a professional venture capital analysis. I think a lot of founders are not used to people in $1 million round doing a bunch of diligence or asking a bunch of questions. But the reason I am is because I'm writing 10x the standard check of that at that time, and I'm trying to get a higher level of conviction.
Okay. And what are we talking about in terms of timelines? On average, from pitch to you writing, doing going through the whole process and due diligence, and then actually writing that check. What are we looking at in terms
It's
of time? Because
between 1 and 2 months.
okay,
I,
oh
I
geez,
need to
okay,
have.
so that's quite quick.
It's fairly quick. I mean, it's not. It's just me and my venture partner. So we don't have a giant team like a lot of big companies, and we don't have a lot of competing deals. But we do founder references. We do our own market analysis. We build our own model and stuff like that. We do more work than most angels, and we don't do YOLO deals. If you call me and say your round is closing at the end of the week, I will say thank you, I'm passing, because I don't have time. I mean, it's
It's
fine. I
good
mean,
to
maybe your
point out.
round does close. Good for you, but
Yeah,
I cannot get conviction in a week.
in a week. Okay, perfect. Right. So there's always, the success stories, which is what everyone shares, and then there's the ones that didn't go so well. So question, unsuccessful ventures, reflecting on your experiences, do you have an example of an unsuccessful venture you invested, and looking back, what is your take on it? What could you have foreseen that, or
Sure.
what if you have an
Every investor has, things that didn't work out. And the only thing that matters to me in those cases is, would you, was it something that you could have known at the beginning, and did you make a mistake? In the ones that have not worked out for me, I have not yet had one where I made a mistake. I was talking to a venture capitalist the other day who had one that he did make a mistake, and it was a diligence mistake. And the company ended up, the CEO ended up stealing the money from the company, and it turned out to be a fraud. The principal who did the analysis and diligence did not Google the CEO as part of his diligence, which was on their diligence checklist. If he had Googled the CEO, in the first page results, there was a securities fraud conviction in the Google
Oh,
results.
wow.
And you would have known that this guy has done this before. They missed that in diligence. In that case, that guy has a real process problem, right? I have not had one of those yet. I have had CEOs that turned out to be fraudulent and stole the money, but that was not knowable at the time we made the investment. So there are two that happened. One was I invested in this company that was doing online fantasy sports gambling. And the company, everything checked out when I made the original pre-seed investment. They raised a Series A. And then after the Series A investor started to get a little uncomfortable with the pace of the numbers and called for an audit, and found out that the CEO was using bots to go to the website and was faking his numbers. And we ended up shutting that company down. But the CEO didn't start that bad behavior until after I made the investment. So, that happens. It's unfortunate, but I couldn't have known it at the beginning because he did not have a history of that. It's kind of like, Theranos and Elizabeth Holmes. I don't think in the beginning when she started it, she wanted to perpetrate a fraud, but she got caught up in it and did it in the end. The other one that comes to mind was a regulatory change, which also was not knowable in the beginning. I invested in a company in India that was trying to build a public.com of India, basically a user-generated stock recommendation trading site. And this is in a prior fund. I wouldn't do a B2C company again. But I like the team. I like their approach. They had some initial great customer traction. They were signing up lots of customers, and everything was going well. And then the Indian government changed the regulations and said, in order to make stock recommendations, you have to have a securities license. So they basically outlawed the
Ah,
company's business model in the middle of the game. And this
okay.
happens, there's nothing I could have known in the beginning other than, maybe I underweighted the potential regulatory risk in my diligence. But that was a change in the market. So my original thesis was correct, but then the market changed and the opportunity went away after. Um, this is not something that I could have known. And the company's now pivoting and trying to do something else. But that also happens a lot, is that some of the core assumptions you make in the beginning turn out to be wrong, right? And my assumption was the regulators would let you run the business. And then it turned out they wouldn't.
Please. So obviously then that gives me another question based on something like this happening. So the second scenario where now they're pivoting, so I'm guessing, you're just waiting to see what happens because you're still an investor, I guess, with
I'm
them.
still an
But
investor, and I still like the team, and if they come up with a
okay,
pivot that I believe in, I might continue to support the company. In that one case, we have not yet figured out what that is. Um, but the idea of a pivot, whether it's forced by changes in your market or informed by customer feedback, that's not a bad thing. I
right,
mean, I think a majority, like more than half of the companies that I invested in, ended up, being something else in the end versus what I originally invested in. Um, this is a common thing that happens. And many times those pivots can be much more successful than the original idea because they're informed by customer engagement. So the pivot is not a problem, unless you don't have enough money to execute your pivot, or your pivot's
okay,
bad.
okay, all right. So in terms of founders, have you had any founders who have exited and come back with a new with a new venture and has approached you and you've I guess invested in him because you've seen what he's done the first time round and then he's coming for round two and you'll say, well, you know what, I know how you operate, I'll write you a check based on your capabilities.
Yes, this is I invest in people that I know. I invested in one company recently. This guy, it's called Augment .co. It's a AI Copilot for your desktop. The founder, Jordan Ritter, was the co-founder of Napster, that I was a service provider to like 20 years ago. He was the CTO of a company that I was on the board of for 12 years called CloudMark, which was an anti-spam company. So I've known the guy for 25 years. And when he comes back and says, I have something new that I want to do, it was a very easy decision to do. So yeah, I do that. But the more important thing is, I like to see founders that are solving an old problem in a new way that they know very well. So, for example, one of my most successful companies is a company called Vega Cloud, which is in cloud waste management. And the guy, Chris Bleisner, he ran a company for 10 years called Second Watch, which was managing clouds for enterprises, but doing it with systems engineers. And every time he got a new customer, he had to hire 5 new systems engineers to run that company's business. And what he realized is that managing clouds on behalf of other people was a very good business, but his approach of using systems engineers didn't scale. And so when he sold that company, he said, I want to solve the same problem, but I want to solve it in software. I want to solve it in a scalable way, in a way that is harder to do, but is potentially more profitable and scalable, and I can serve more people. And so he was solving an old problem that he knew very well with a new set of technologies. That particular model is incredibly powerful for a founder. And I was one of their first investors, and it's going very well.
Fantastic. Successes, highlights of your journey. Is there anything in particular that stands out for you as an investor in your journey since you started investing when you were at Microsoft and now?
Well, a bunch of things. I mean, it was nice being one of the first investors in DocuSign. I think we made 400 times our money there. But one of the really powerful lessons for me as an investor was the power of being an LP in venture funds. I started angel investing when I was at Microsoft, and I was investing directly in companies. And when I was in Silicon Valley one day, I met this guy named Ron Conway, who ran Silicon Valley Angels. And he's like, I run a venture fund and I invest in companies. And I'm like, what's a venture fund? And he said, well, I raise money and I go invest on your behalf. And I was like, oh, that sounds interesting. You'll probably find companies that I don't know, and here's some money. And he was over at Stanford one day and met these two guys named Larry and Sergey, and gave them their first check, and ended up giving the LPs in the fund IPO shares in Google, some of which I still own. I wish I owned them all. And my cost basis on Google is 50 cents, and so I'm never
Wow.
selling those shares. And that's been a lifetime lesson of really how transformative it can be involved in some of these companies very early that end up transforming entire economies. And I'm looking for more companies that are going to be that 20 years from now. But I've been involved early in some companies that are now very much household names. I mean, I was an investor. I was an employee of Microsoft before the IPO. I was a Series A investor in Google. Those are pretty powerful lessons on the power of investing early in great people.
Fantastic. Challenges in your activity. Difficult times faced, as in, do you foresee anything? Is it difficult at the moment or within the next, I guess, 18 months? Because we often see on X a lot of people saying, oh, this is a complicated time, etc. What's your take on the challenges that we potentially face or founders face when dealing with investors?
Well, we are after a crash, and we're starting to come back a little bit in the public markets, but it's not a very deep recovery. It's all the mega caps, and we haven't seen the IPOs return yet. I mean, it is a hard time for venture capitalists to raise money because a lot of LPs got burned in the most recent bursting of the venture bubble. So it's harder for venture capitalists to raise money at this, and it's hard, and therefore it's harder for entrepreneurs to raise money. But the inverse is also true, that it's the best time ever to start a company. I mean, I saw a study a couple of weeks ago. They interviewed 1,500 people that had been laid off by big tech firms. Fully 68% of them said they want to start their own company. And if you look historically,
Wow.
after bubbles have burst in 2001 and 2 and 2009, company formation explodes. Like, lots of people start companies. And it's an incredibly good time to start a company and to invest. The hard part is to be able to write the check when it's hard to get the capital. I have a venture fund. I'm deploying capital. I have limited partners who agree with that thesis, but it is a little bit harder to do. The number one risk in pre-seed today is follow-on financing. I mean, basically, up to about a year and a half ago, we were in a 12-year bull run of venture capital. And at the end of it, you could, CEOs could plan on raising every 6 months and at an increasing valuation every time for almost any company. We are not in that environment anymore. We're in much more of a milestone-based environment. And the follow-on financing and the A's and the B's that are happening, the bar is very high. Until about 2 years ago, you could get a seed done, and I'm talking in B2B software, not all companies, with about $200,000 of ARR for a seed and $1 million of ARR for a Series A. Today, those numbers are $400,000 or $500,000 of ARR for a seed and $2 million for an A. You used to be able to get a B done with $5 million. It's now $10 million. So the traction metrics are higher for each round. You can get rounds done, but they're only the best companies with the best metrics are getting the rounds done. So what that means is that at each stage, you need to raise more money than you thought. I mean, until about a year and a half ago, I would invest in a pre-seed that gave a company 12 months worth of runway. Today, I'm not investing unless you're getting 18 to 24 months worth of runway. And the reason is because you've got to get farther with that money to attract the seed investor than you did before. These pre-seed guys are like, we're raising 6 months of runway. I'm like, you're going to be out of money. Like it's a roach motel. Like there's no chance you're going to be able to get far enough to raise more money with 6 months of runway. It's just not going to happen.
Okay. And do you obviously going to talk on the fact that when someone comes and I guess it's a due diligence issue. How does one, figure out whether there's going to be numbers are hidden or falsified, if that makes sense? Is that something that's a challenge, when it comes to auditing and things like that? What are the solutions for this sort of problem?
Well, it is a trust relationship, and it's very difficult for VCs to be able to know. There are some companies and venture funds that have built technology to do this. For example, in the company that was doing the gambling, one of the co-investors was Goodwater Capital. And Goodwater Capital focuses on B2C companies, but they have a giant third-party data tracking system where they are looking at SimilarWeb and Product Hunt and all of this information. And they have a dashboard on every company. And they're able to look and see what the third-party data on these applications say. And then they compare that third-party data with what the CEO is giving in their monthly reports. And if they see a difference, which they found in this company, then they go and it's a flag and they say, what's going on here? Because the third-party data doesn't match the first-party data. And I think you're going to see more people doing that kind of thing, is trying to do a little bit of validation. It's very hard if the CEO is actively, trying to deceive investors. One company that I invested in ended up providing falsified bank statements. And the only way I found that they were falsified bank statements is that I asked my banker who was at the same bank to verify some bank balances, and they said that person doesn't have an account here. So.
Oh, wow. The thing is, like, you would think that, you're raising money, there's going to be some form of due diligence. And sometimes it can be, you've got some VCs or investors who are really going to dig because it's their money at the end of the day, and you want to know where you're going to be putting it. But yeah,
well, I
it's
mean,
just one of
founders
those
should
things
expect
why people don't give it a second thought.
Yeah, founders should expect that VCs should dig. VCs should dig. I mean, like as part of my diligence, I ask for bank statements. I ask for investor updates, and I verify the bank statements. I mean, that's one reason it takes me a month or two, is that I have to be able to verify as long as everything the CEO is telling me checks out, it's fine. But surprisingly, in 20 or 30% of the cases, when I ask for bank statements, the CEOs say, we can't give them to you. Well, if you can't give me your bank statements to verify the numbers in your PowerPoint deck, I'm not going to invest.
But that's, it's not rocket science. I mean,
it's not rocket science, but that's how you identify. I mean, just ask some simple questions. Like, give me your bank statements and let me compare the bank statements against the traction slide
numbers
in your pitch deck. If it matches,
100%.
fine. If it doesn't, or it's not going to, and you're not going to give it to me, that's also fine. I'm not investing.
Okay. It's that simple.
It's that simple.
Yeah.
But that kind of behavior,
Mhm.
we have time to do it now, and I have always done it. Um, People did not have time to do that in the bubble when they were given 3 days to make a decision. And this was bad for everybody. It was bad for the founders. It was bad for the investors. It's bad for the ecosystem because, shady deals got through. And some of them were shady and worked fine until they blew up, like FTX, right?
Yeah, absolutely.
And
Absolutely.
and some of them were shady and were fine, and people made money and nobody knew. But I like the environment we're in now, where people have time to make a considered, incisive decision, because this is a 10-year partnership, and you should want to know. I encourage CEOs to do reference checks on me, right? And like I want to give them time to call other CEOs and other VCs and ask about me. I think it's a two-way street. And in the YOLO times, when you had 4 days to decide on an investment, neither party could do their diligence,
I did the due
and that's
diligence.
that turns out to make a bad partnership.
Okay. I mean, that's a very valid point. I mean, the due diligence works both ways. I mean, you're actually
It
entering
should.
into an actual relationship. So that's
Yeah.
that's something that, and if it's a relationship, it means that it goes both ways. Due diligence, etc. So great, Martin. We go into a couple of fun facts about you, and then it'll be a wrap. We'll take a couple of questions if there are any, from those who are streaming in. The majority, I think, are streaming in from X.
Super.
So fun facts. How much time do you spend on your phone screen for non-work related things?
Too much.
Okay.
Probably like 2 or 3 hours a day.
Okay. And non-related, what are you doing in terms of what are you looking at? Are you scrolling on social media? Are
Oh, no,
you
no. Usually, I mean, it's sort of half work or half not work. A lot of times it's playing poker with some other VCs and founders.
okay?
It's not
All right.
exactly
True.
work, but I do love the
Yeah.
poker.
Okay. Fantastic. Bucket list item to tick off in 2024. Can be anything.
Um, I'm doing a family trip to Europe. I'm taking my daughters to Paris and London, and they've never been. It's going to be really exciting. And then on a personal trip, I'm going with some other VCs and founders to ride our mountain bikes in Bentonville, Arkansas. And if you never heard of Bentonville, it's like the mecca for mountain biking. Go to watch some YouTube videos. It's insane mountain biking.
Okay. Great. 10-day yoga retreat or 10-day mastermind retreat?
Neither.
Okay. Beach house retreat or mountain cabin getaway for unwinding after a tough deal?
Beach, surf. It's got to have surf, not just
Okay.
beach. It's got to have surf.
That's got to have surf. Okay. Fashion. Do you rock a hoodie and sneakers or a suit and tie for important meetings?
I think you'll see I'm a hoodie or t-shirt guy. I am a big fan of a standard outfit to reduce decision fatigue. I wear a black t-shirt basically every day.
Okay. Makes sense. Coffee or tea? So I know you're a big coffee drinker. Um, but what kind of coffee, if you could choose any, or what's your preferred type of coffee? Colombian,
Well,
Kenyan.
the origin is not as important as the purity. There's a big problem in coffees, which is mold on coffees, causes lots
Mhm.
of toxins. So I get organic, not mold-free coffee.
Okay.
And the origin isn't as important to me as the fact that it's organic and certified mold-free. It's an astounding amount of coffee that has mold in it. Because if you think about it, It's packed somewhere tropical and hot and
Tropical,
warm, put in a bag, put in a boat, and shipped for 3 months. It's going to have mold in it.
100%. And then comedy night or TED Talk marathon for a fun evening out. What's your pick to unwind?
What are the questions? TED Talk marathon or
TED Talk marathon or a comedy club night?
um, probably the comedy club. Uh, there's a couple of good guys I've seen lately. Yeah.
Okay, great. And then sports. Where would you thrive? Single competitor, double sports, relay team, or team sport?
Single competitor. I used to play soccer. I hated it. I mean, if you see my sports, mountain biking and surfing, single competitor sports.
Single
For me,
competitor.
it's competition against myself.
I like it. Competing against yourself. That's really, I got to write that one down. Okay. And then I guess that wraps up our podcast. So I don't know if there's anybody or any questions for those that are streaming in, but also in the meantime, while we take questions if there are any, um, we're putting down on the ticker Martin's Twitter handle,
Twitter.
where you can follow him definitely, as well as the website Incisive VC. So before starting to throw your pitch decks around, please go through his website and actually read his blog as well and get an understanding of what Martin likes, what he wants, and who he's interested in pitching. And if you fit the all the above, then please don't hesitate to reach out. And if not, well, there's other people who would be potentially interested in your pitch deck. So we're just going to give a couple of seconds to write down your contact details as well as questions if there are any.
Sure. And there's another interesting thing where I'm going to add this podcast to the AI bot on my website, incisive.vc. There's a link to chat with me, which is an AI bot. And the AI bot has been trained on all of my blog posts and all of the podcasts that I've done. So I ended up answering, the same questions a lot of times on podcasts. But if people have questions, you can ask like, what's your ticket size? What's the sectors you like to invest in? What are the sectors you don't like to invest in? All of that is available in a chat bot on my website.
Fantastic. So I'm going to leave that there. No questions for the moment. So I guess that's a wrap in terms of timing. I don't think we could have done better. 58
We did
minutes.
great. Thank you for doing
Um,
this.
Martin, it's a real pleasure, and I'm looking forward to staying in touch. And I'll see you in London in June when you're over, with pleasure. And if you need any recommendations, I don't know if you recall, but I also have a private concierge business. So
You mentioned that.
um,
I
definitely more
appreciate
than
that.
happy to to arrange a couple of VIP experiences for you and your daughters when you're over in Europe.
All right. That would be cool. Thank
All
you.
right, fantastic.
Take care.
Martin, have an awesome day and a great week, and we'll be in touch. And thanks for joining the podcast. It's been a pleasure.
Thank you.
Cheers, Martin. Bye bye.